Realty Income is one of the most popular monthly dividend REITs. So today, let's see what happened in its most recent fourth quarter earnings call. The management started the call discussing investment performance. In 2023, Realty Income achieved an annual high in property level investment volume, closing over $9.5 billion in high-quality, diversified investments across 8 different countries through 271 discrete transactions with a weighted average cash yield of 7.1%. And the fourth quarter stood out with particularly active investment activity, totaling $2.7 billion at a weighted average cash yield of 7.6%. Here are some large investment deal examples. First, in 2023, Realty established a presence in data center sector through a build-to-suit development joint venture with Digital Realty, which will be discussed further in a later section. Second, Realty also incubated new relationships with blue-chip partners such as Blackstone and the EG Group through significant investments like the $950 million of investments for a 21.9% stake in the Bellagio Hotel and Casino in Las Vegas, and the $1.5 billion sale-leaseback transaction primarily involving Cumberland Farm convenience stores. Lastly, Realty announced a $9.3 billion merger with Spirit Realty Capital in an all-stock transaction in October. And this deal was successfully closed on January 23rd of 2024. Now onto financial performance and guidance. Realty accomplished an AFFO per share of $4 in 2023, indicating an operational return of approximately 7% for the year. And according to the management, with the successful completion of the Spirit merger and strategic capital raising activities in December and January, Realty is positioned for substantial earnings growth again in 2024. And they provided this year's AFFO per share guidance in the range of $4.13 to $4.21, projecting a 4.3% annual growth rate at the midpoint. And they are expecting to achieve this growth without resorting to additional public equity. Realty targets a total operational return of more than 10% at the midpoint of the guidance, based on the trading price of its common stock as of February 20th, 2024. And then, the management highlighted 5 reasons why Realty is best positioned to capitalize on compelling opportunities over the long term. First, there's a vast opportunity to consolidate the fragmented net lease real estate market, which is estimated to be about $14 trillion of TAM in the US and Europe. Second, Realty has demonstrated capabilities in deploying capital, investing $9 billion or more annually, with a track record of generating annualized AFFO per share growth of approximately 6% and providing a total operational return of 10% per year. Realty anticipates a similar capital deployment and AFFO per share growth in 2024 and beyond, and they are particularly excited about participating in data centers and gaming verticals, where opportunities present for earning healthy initial yields with attractive contractual rent escalators. Third, the Spirit merger enhances access to capital markets through increased trading volume in publicly listed stocks. Since the announcement of the Spirit transaction, daily trading volume has averaged more than $400 million, positioning the company in the top 150 of S&P 500 companies. Fourth, its real estate portfolio is experiencing increased diversification over time. Diversified exposure enhances the stability of the platform and contributes to the growth of monthly dividends. Fifth, the power of the platform serves as a crucial differentiator, leveraging expertise across ownership of over 15,400 properties globally. And with experience managing since 1996, Realty utilizes learnings to develop analytic AI tools. These tools provide actionable insights, allowing for more accurate identification of acquisition opportunities and maximizing the value of existing holdings. Moving on, management provided updates regarding the Asda deal in UK at a yield of 10.9% and the Bellagio Casino deal with Blackstone with an 8.1% yield. Since we covered these deals in detail in the third quarter earnings summary, today we'll focus on other parts. And regarding the Realty Income's venture into the data center space, in the fourth quarter, the REITs initiated a JV with Digital Realty, which is yet another public REIT that focuses just on data centers. This deal involved $200 million of initial investment, representing an 80% equity stake in the new data center. This venture is expected to generate a 6.9% of initial cash yield, 2% annual rent escalators, and a long-term triple net lease with an S&P 100 investment-grade client upon completion. Next, regarding capital markets activities. In the fourth quarter, Realty raised $1.6 billion of equity with a weighted average price of $56.25. Including subsequent activity after year-end, there is currently approximately $605 million of outstanding forward equity available, poised to finance a portion of additional equity needs in 2024. From a debt capital markets perspective, Realty de-risked the 2024 maturity schedule through approximately $2.2 billion of bond issuance. This includes a £700 million of sterling notes offered in December and a $1.25 billion offering that closed last month. The combined offerings have a weighted average tenant term of approximately 10.2 years and a weighted average yield to maturity of around 5.5%. Additionally, Realty exercised the first two one-year extension options on its $1.1 billion multi-currency term loan established in January 2023. And finally, a 2-year floating to fixed interest rate swap was executed, effectively locking a fixed rate of approximately 4.8% on the principal through its maturity date in January 2026. Key credit metrics at the year-end indicate a net debt to annualized pro forma EBITDA of 5.5 times, and this aligns with the targeted leverage ratio. Purchase price accounting adjustments are ongoing for the merger that was recently closed, and finalization may push FFO higher, impacting FFO guidance in the future. So as shareholders, we should focus on the AFFO numbers, which will adjust for these short-term effects. On a closing note, CEO Sumit reiterated the core mission to deliver dependable monthly dividends that grow over time by serving as a capital provider to leading real estate assets. Now, let's see Realty's fourth quarter financial performance. Total revenue for the quarter was $1.1 billion, up significantly 21% from last year. And for the entire year of 2023, total revenue was $4.1 billion, up 22% year-over-year. Same-store rent revenue for the fourth quarter was $713 million, up 3% year-over-year. And in the following orders, theaters, casual dining restaurants, and convenience stores contributed the most to this year's yearly change. And for the entire year, same-store rental revenue was $2.9 billion, up 2% year-over-year. By adjusting for recurring capex, amortization, and other non-recurring items, Realty Income delivered an AFFO of $731 million to shareholders, which is up 15% year-over-year. But on per-share basis, AFFO in the fourth quarter was $1.01, up just 1%. And for the full year of 2023, this number was $4.01, which is up just 2% year-over-year. Now, let's move on to the most important moments of the Q&A section. Regarding questions related to current real estate investments, the management said that recent fluctuations in the 10-year Treasury rate indicate seller hesitancy due to expectations of future interest rate cuts by the Fed. And in this uncertain environment, sellers may delay transactions because they anticipate a more favorable market in near future. In any way, Realty's management is focused on delivering a 10% plus return without taking aggressive market strategies. And regarding investment spreads, the management team claimed that the ability to generate a 200 basis point spread on free cash flow is still feasible. Although achieving a 200 basis point spread was easier in a different cost of capital environment a few years ago. And in recent years, the average spread came down to 150 basis points. And there is an acknowledgement that spreads may vary due to changes in the cost of capital during the transaction process. And most recently, in the fourth quarter, Realty experienced spread as low as 120 basis points, which is quite far from the target of 200. And regarding this problem, the management claimed that Realty does not rigidly pursue a fixed 200 basis point spread in every single transaction. Instead, it employs a bar-build strategy. This strategy allows for consideration of transactions with spreads as low as 100 basis points, prioritizing the right risk-adjusted return profile. And here, they're basically saying they make investment with lower return because they're also safer assets. So overall, the spread is definitely narrowing, and the management's answer was half convincing. So investors should keep an eye on this trend. and also manage their future expectations for Realty Income's profitable growth in coming years. Next, management discussed that real estate development, as opposed to investing in already completed assets, as an additional tool, not a dominant part of the business. The expectation is that the yield generated through development should surpass what could be achieved in a transaction market. This is because realty takes on more risk, like the JV with Digital Realty recently. And regarding the environment in Europe, the overall transaction volume was lower versus the US due to a disconnect between buyers and sellers. Despite these challenges, there are pockets of opportunities, especially in the UK, where transactions are still feasible. The cost of debt in Europe is notably lower by 110 to 120 basis points, making it an appealing factor. Clearly, the low transaction volume is not unique to the US, but is a trend across all geographies that Realty operates. Regarding Spirit merger, no negative surprise has emerged, but rather positive surprises have been noted, with outcomes being slightly more positive than expected. As a result, it looks like the Realty can achieve better synergies than originally expected. On a cash basis, Realty anticipates $30 million in synergies. There was also a question about Realty's increased activities in real estate, credit, and sale-leaseback space. And management answered, the focus in the credit business is becoming a one-stop shop for clients who have engaged in traditional sale-leaseback transactions. This approach is not limited to specific sectors, with examples including credit investments in gaming with Blackstone and a significant grocer in the UK. And given that credit is not a core element of Realty's business, selectivity is emphasized in lending decisions. Regarding the high and low ends of AFFO per share guidance, the high-end scenario assumes improvements in the macro environment and also in cost of capital. On the other hand, the low-end scenario is at $4.13, and this assumes a belief in ongoing short-term rate increases and anticipates a potential acquisition shutdown, resulting in a figure significantly below the stated $2 billion. Lastly, the increase in income tax, particularly in the UK, is a result of international business structure and the taxation policies associated with it. Such international deals have negative tax consequences, but the management said that these negative impacts are already baked in when they make investment decisions and calculate the long-term IRR. Now, in this last section, let's dive into Realty's largest European deal a little further. Recently, Realty Income announced a 527 million euros inaugural pan-European deal with Decathlon, one of the world's leading sports brands. This portfolio involved in the sale-leaseback transaction for 82 retail properties located in Germany, France, Spain, Italy, and Portugal. This sports brand company was founded in 1976, recorded 15.4 billion euros in sales in 2022 across 1,751 stores globally, and the company has an investment-grade rating. This transaction reflects Realty Income's ownership of high-performing assets that Decathlon is committed to rent and use for long-term, with an average store operating for 18 years. This seems to be a more common deal that Realty Income is pursuing recently, so investors should have a confidence in such strategy to believe that Realty can continue on its successful path into the future. Okay, that's it for the summary of Realty Income, and if this video was helpful, please hit the like button below and subscribe to the channel. And I'll see you guys in the next video where I will summarize NVIDIA's Q4 earnings result. Thanks guys.